Hi Money Masters, my name is SJ. I hope you are having a good day today. In today's episode, which is stream 1, episode 3, I'll be looking at the different types of returns and demystifying the way that people tell you what return you received on your savings or investments. You think it's easy, but there are people out there that want to bamboozle you. Not anymore. Stick with me, and if you're here at the end, there's nothing special at the end today, but I'd really like you to watch to the end. Let's rock and roll. When I did my video on inflation, you may remember that I had my Destroy Excuses t-shirt on. Today I've got this pattern. As you can see, it's a bit fuzzy and you're starting to feel drowsy and you're starting to feel like you want to pay your money into my bank account. No man, just joking. What we are going to do today is demystify or translate the jargon of returns. So a quick overview. The returns I'm going to cover today may not be every single type of return, but these are the most important ones that I want you to know about. So those returns are nominal returns, total return, real return and relative return, and absolute return. So I'm going to look at each of those returns with an example so that you can know when people tell you what type of return you received on your savings and investments, what does it mean, or what are the questions you should be thinking and asking about to make sure that the return is a decent return. I'm going to look at returns using a table again. I know, me and my tables, but I promise I will explain the table carefully so that you can follow along and understand the returns. So the first return I want to have a look at is the nominal return. You can see this is the type of return column. This is the nominal return. I'm going to use again a price in the beginning, 1 January, price at the end, 31 December. Why? Because we are talking about annual returns, year on year or 1 year returns. And then this column is the percentage change. So $100 went up to $110, which is a $10 difference, and that is equal to a 10% change in price. For the purpose of this table, each return that I'm going to discuss will go the price from 100 to 110 to keep it all consistent. We don't want to make that more difficult or complicated. Okay, so back to the returns. A nominal return, when something went from $100 to $110, percentage change is 10. The answer, in other words, your nominal return is 10%. That's an easy one. 10%, that's a straightforward price change. Okay, let's look at the next one. Total return. Okay, total return. Exactly the same. We end up again with a 10% change, but imagine you're holding one stock only. So if you like to think in tech terms, let's imagine you're holding Microsoft. If you like more the bricks and mortar type of business, let's imagine you hold Coca-Cola. Now I know neither Microsoft nor Coca-Cola trades at $100 per share and goes up to $110 per share. That's not important. That's just for you to have a picture in your mind. But these companies often pay a dividend. So let's look at total return. Your price went up by 10%. The company paid 3% dividend. So your total return, the return that you actually received, is 13%. So slightly different, and in this case, assuming the business or the portfolio or the stock you hold paid a dividend, your total return is higher in this case than your nominal return. The next return is a real return. What does that mean? If you haven't seen my video on inflation, please go and have a look at stream 1, episode 1 and 2. More specifically, episode 2 That is inflation part B. That is where I explain how inflation has an impact on the value or the worth of your money. So let's have a look at what real returns mean. Basically, same story, 10% increase, but inflation is assumed. Let's say inflation was 6%. Then your real return is 4%. 10 minus the 6, 4%. In the real definition, the real return, you have to account for inflation and taxes. But depending on the country you're in or your tax bracket, that differs for everybody, so I didn't take it into calculation here. But really what you want to do is you want to say, if I have the return or receive the return, minus inflation, and after I've paid fees and taxes, I want a positive number, a real number. And the reason for that is if you can get positive real returns, your money is getting worth more, your investment, your savings and investments are growing at a rate higher than inflation, and you are getting wealthier. The next return I want to have a look at is the relative return. So relative return is relative to something. In this case, I said the 10% change in the value of your investments or savings. We're using a benchmark of 8%. That means you have a positive relative return of 2%. So your 10% is 2% better than the benchmark. Now benchmarks in themselves again can get extremely complex, and there's a lot of calculation that goes into it. But I'll give you an example about a benchmark. Let's assume I say I ran a 100-meter race, and I ran it in, let's say, 13 seconds. So is that good or bad? So I have to compare it. I have to have a benchmark to compare it to. So the first benchmark I could use, I could say, if I ran against other people of my age, my gender, let's say, my fitness level, did I run a fast race or a slow race? So if I say my 13 seconds compared to them, the average of the other racers or runners in the race, let's say, is 13.5 seconds, then in this case I did better. My relative return or my relative race time is better than the benchmark. But depending on what benchmark I use, this can look totally different. So if I say I ran the race in 13 seconds, how does that look relative to Usain Bolt? It doesn't look so good. Then it looks like I'm running at the speed of a herd of turtles stampeding through butter. So it is very important that when you use relative returns to see whether your savings and investments have done well relative to a benchmark, it is extremely important to have the correct benchmark. And that is a science in itself. And I'll explain some of that again in a later video. But the relative return is your return relative to a benchmark. The last return I want to look at is the absolute return. Absolute return, you'll see there's nothing else in these columns. Absolute just means a number bigger than 0. Now in the examples I use in this table, all your returns were positive, so absolute, positive 10%. And I used examples that make you feel great about savings and investments. All your numbers here are positive. Now there's two things none of us want to do. We don't want to get rich slowly, and we do not want to lose money. You've worked hard for your money. You've taken the step to start saving and investing. We do not like losing money. But unfortunately, the only guarantee with savings and investments is that at some points in time, you won't get positive absolute returns. That is why I want you to stick with me through the Money Master channel. Wherever you see this logo, that is the subscribe logo. So please go ahead and subscribe and like the video if it helped you. This is the main purpose of this channel, to help you understand concepts like returns. Then I want to help you to understand and master your emotions and behavior, so that when we get to the time where we don't get the positive real returns, you know it's coming, you know how you're going to feel about it, and what the right thing is to do at that point in time. I am so looking forward to sharing all of that with you. The next video I recommend for this channel is the one on risk. That is a unstreamable video. Why? Because it fits into stream 1, 2 and 3. I'm going to talk about the concept of risk. What does it mean when it comes to savings and investments? Why are we as humans risk averse? What happens to us in how we feel about when what we are warned about, we are warned about it, but when it happens, why do we feel a certain way, and what is the way that we should be thinking about situations like that, so that we don't shoot our own left knee off when it happens and we make wrong choices with our savings and investments. I'm looking forward to bringing that video to you. I'll see you in the next one. Cheers.